Hey, Joe, thank you for the presentation. And as a reporter covering the startup space, is actually very refreshing to hearing about a non-pre-revenue billion-dollar AI company these days. So it's interesting to see how you guys almost emerged from the pandemic as a little bit different company. And I want to follow up on the TAM and the growth opportunities from here in your presentation. You mentioned Linden has been a very successful example. How many Lindens are you seeing in this world, and where will be the growth opportunities coming from?
One of the things we look at is how many markets can get above, let's say, 8,000 or so vehicles in a city. And so that is one of the metrics that we track. I believe we, at this point, have 8 or 9 cities that have achieved that level of scale. I apologize that I don't have it right off the top. But what we continue to see is that dynamic that as we press vehicles into a city, we see growing reliability, which drives growing utilization, which drives growing margin, because again, any fixed asset business, you want it utilized more. That's the cheapest way to grow, is greater utilization than CapEx. So I think over time, I don't know, this is a rough guess, I would think that 25 plus markets can get to the kind of scale of London, and those were 2023 numbers, so I'm excited to share what London looks like in 2024. But we've also seen micromobility work in a variety of smaller markets as well. There are really 3 use cases. I don't know, who here has actually ridden a Lime or a competitive product? All right. The 3 use cases are commuting, and our best customers are all commuters. The second is what I would call transportainment. You and a friend decide to go grab coffee, then you go to an exhibit, then you go to the ball game, then you go to a bar, and you make the way you get around part of the fun. So we're competing there for entertainment dollars. And the last one is tourism. This is the best way for you and your family to see a city. And the reason is, when you go to Paris, if I gave you a teleportation button and you could push it and get from your hotel to the Louvre, from the Louvre to the Eiffel Tower, would you push it? I'd say 9 out of 10 times you probably wouldn't. Because you're there to see all the places in between point A and point B. You're not just there to see a staccato burst of the greatest hits. You want serendipity. And micromobility is a great way to do that. It's why you walk in cities, but at 3 times the speed. So we have my view on pricing is your pricing power is directly proportional to how much better you are to the next best alternative. We have very strong pricing power in tourism because the next best alternative is being in a bus or a subway or an Uber. We're really isolated from the experience. Then in the second best is in the transportainment category. We're competing for your entertainment dollars because you're out to have fun. We have the lowest pricing power in commuting, but we have the greatest volume of profit dollars there. So we have differential pricing. We're able to sell the same trip essentially for different prices based on the way we structure our pricing and make it worth your while as a commuter. We'll take smaller margins, but get a higher absolute dollar profit volume. So sorry to pivot your question, but I wanted to explain further.
That's super helpful. And on your point of turning this company into a good unit economics company, I would imagine you have been going through the journey of going into a market and trying to improve the unit economics and seeing the rate of profitability there. I'm curious, what are the lessons and in general that curve looks like for each market?
So I believe that the job of a startup is to systematically and sequentially, and I say those words very precisely, systematically and sequentially retire the most important risk facing the business. That's it. The hard part of leadership is, what is the most important risk? And sustaining focus on it. Until the end of 2023 and for the prior 4 years, we had only one question we needed the risk we needed to retire, which in a question is, can anybody make money in this business? This is just too hard. You know, you make your money in like $3.50 increments, you're running fixed assets in 280 cities, people throw them in rivers, steal the battery. You know, in theory, there should be a business here because there's a last mile transportation need and cars are expensive and cities want them. Maybe in practice, it's too hard. So we obsessed about retiring that risk and proving beyond a shadow of a doubt, not with a presentation, not with EBITDA, but with free cash flow, that you can make money in this business. And now we get the privilege of focusing on the next most important risk facing this business, which is how do we continue to grow at that 30% year-on-year growth rate indefinitely into the future? And that, as a builder, is really exciting for me because I love to obsess about customers, and we get to grow through customers, voting with their feet and their wallets in preferring Lime. And so we're very disciplined. I believe in this phrase, you make hard choices when you have choices to make, not when you don't have any other choices to make. Let me give you an example. In the middle of 2023, we were on our way. We knew we were going to be free cash flow positive that year. We sit around at our leadership offsite, and Wayne, CEO, says, we're going to cut our OpEx run rate by 10%. You imagine most companies, when the sun is shining, when you're about to make free cash flow, don't go around cutting OpEx. We do. Because we're obsessed on cost, we're obsessed on financial discipline, we make incredibly rational allocation decisions of where we operate. We don't operate in unprofitable markets. And so the short answer is most of our markets are profitable instantly on a unit basis simply because we won't tolerate anything else, and we've proven we don't have to. That's the best way I can say it.
And as a former VC, now that you have cracked the codes to prove to the world that this business can be profitable and scalable, what are the chances you think other VCs sitting here today would not back another businesses in this field?
Well, I don't know that there's a line of capital providers at the door that are excited about investing a few $100 million in a capital-intensive business that they want to get to scale through an RFP process. So maybe they're out there. I hope to convince them to put money into Lime and grow on that way rather than invest in something new, but it's possible. But I think that the second piece is, as a former VC, I still serve on many boards and I make probably 2 personal investments a year. I'm a nightmare board member now. I sit on some SaaS company boards, and the imprecision with which they operate their businesses and their P&Ls is maddening to an operator like me who's operating in a game of inches business in a low margin business. So I'd be excited if most of the SaaS companies that I sat on had the operational intensity and P&L discipline that we've been able to exhibit at Lime. There's probably 7 or 8 points of margin at least in most of those P&Ls. So I'd love to get my hands on some of those as well.
After this, last questions. You guys are already cash flow positive, and as a company that you can kind of sustain its own and control your own destiny, and how are you thinking about the path to going public and what it means to the company?
I think that the next capital raise that Lime does hopefully can be a public offering. We're in the very beginning stages of our non-deal roadshow and building relationships with investors, and I believe we need to earn trust of the markets. So what I'm excited about doing is 2 things in this non-deal roadshow. One is building relationships over the course of the next year when we come back quarterly and talk about what we said we'd do and what we did. How do we react to adversity? Do you see us delivering on our commitments and our promises? Do our forecasts turn out to be true? We won't get it right all the time, but I'm excited about building those relationships and being held to account. The second thing I want to know is I want to meet with the harshest investors possible. What I mean by this is what I love about meeting with skeptical investors, and all investors, myself included, should be and are skeptical. I want to know all the reasons you're not letting me leave the room without me taking your $100 million check. You tell me those things, now I have a list of things I'm going to go work on. So I've used this process over and over again. If you can get an investor to be rude instead of polite, if you can get an investor to be precise instead of general, and you can get them telling you all the things they hate about your business, I don't take it personally. I take it as that's the next set of risk I want to reduce. And when I do, I'm going to come back to you and I'm going to get your check. Or you're going to tell me the next set of things that prevent you and I'll be better next. So I think we believe that we can be a good public company. But we need to find that out now over the next year as we go and make contact with the market. And the reason we're doing so is, I put $100 million of Google's money into this business. I didn't do it for charity. I did it for a return. So we owe our investors liquidity. And we think that there's opportunities as a public company for Lime, whether it is M&A, lowering our cost of capital, to use that capital to expand even further.
Jill from Lime. Thank you, guys.
Thanks, everybody.